Hello and welcome to our latest dairy market update. As we approach the second half of the production season, we take a look at how the global and domestic markets are developing and the outlook for price developments. Milk production has hit 25-year highs almost every month from January to June. Total deliveries in the first half of the year were up 2.8% compared to last year and 3.7% compared to the 5-year average. This occurred due to high yields in the first quarter of 2019. These were the result of an increased use in purchased feed over the winter and excellent grass growth through the spring and summer. Milk production in the EU 28 between January and June of this year did not show the same growth, with total deliveries up by only 0.4% year on year. Declines in production in Germany, France and the Netherlands have mostly offset the growth seen in Ireland, Poland and the UK. Availability of dairy products in the EU markets has varied, impacted mostly by trade flows. Total available supplies of butter and cheese in the 12 months to May were on a par with availability last year, while S&P supplies have been depleted by strong exports and a drop in production over the period. WMP supplies are up as export volumes fell over the year. The lack of excess stocks of most dairy products, along with the limited supply growth in key dairying nations across the world, has helped to limit downward movements in wholesale prices. The exception is butter prices, which has been declining steadily since summer 2018 as demand has dropped, particularly from the food manufacturing sector. Despite lower market returns, UK farm gate prices have remained in the region of 29 pence per litre on average over the 12-month period from July 2018 to June 2019, slightly above the 5-year average of 27.5 pence per litre. Looking at the global situation, production growth for 2019 is expected to be limited. Weather is the main issue limiting growth, although low margins in the US and Australia are also playing a part. New Zealand has started its new season on a high note, although Fonterra's recent financial results, leading to the absence of dividend payment for this year, have put some pressure on New Zealand farmer margins. Product availability across the main exporting nations is estimated to be well balanced. There is some build-up of cheese stocks in the US as high prices and trade tensions are limiting their exports. On the demand side of the market, China's import demand has been strong so far in 2019, with the exception of whey. However, it is uncertain at this point if the higher imports have led to stock building or have simply replenished stocks after lower than normal imports in 2018, leaving room for continued purchasing through the winter. On balance, the outlook for commodity prices at a global level is relatively stable. Any downside risk will come from the impact on China's import demand from the weakening of its currency against the US dollar and the effects of slower economic growth in the US and EU on consumer spending in those markets. At a domestic level, milk yields are expected to return to normal levels in the second half of the year. Concentrate usage is likely to drop as farmers make use of plentiful silage stocks in a bid to rebuild margins. This, combined with the reduced milking herd, is expected to lead to slower growth in milk deliveries in the coming months, compared to what we saw in the first half of the year. The high milk deliveries in the UK has put pressure on market returns, particularly for those processors dealing in fat-based products. This has led to some cuts to farm gate prices in recent months, which have predominantly affected those supplying liquid milk markets. On balance, the lower rate of growth in milk deliveries should reduce some pressure on wholesale markets and provide some support to farm gate prices as we move into the new year. However, this outcome does not account for any impacts from leaving the EU without a deal. Brexit outcomes will of course play a major role in market development in the final quarter of the year. In a no-deal scenario, exports could be severely disrupted, leading to increased pressure on processing capacity in the case of raw milk in Northern Ireland and a build-up of stocks in the case of cheddar cheese. Both of these situations would have negative cash flow implications for manufacturers, with the potential to put downwards pressure on farm gate prices in time. For more information on how to leave the EU without a deal could impact on the UK dairy sector as a whole, please visit the Brexit section on our website.